This is the Asia Trade. I'm Shery in Tokyo.
And I'm Annabelle, Droulers in Hong Kong. The top stories this hour. Asian stocks set for a weaker open after Wall Street struggles for direction. Treasuries take a hit as traders weigh the economic implications of the US presidential race. Donald Trump unlikely to face trial before the election over the January 6 riots, as the Supreme Court rules presidents do have some immunity. Plus, Australia debates going nuclear in the race to balance lower carbon emissions and sustainable power supply.
And we'll start you off with breaking news out of South Korea. We are getting the CPI numbers for the month of June, gains of 2.4% year on year. So it's a faster deceleration that was estimated at 2.6%. It's also deceleration from the previous month. Of course, we were expecting some of those food prices to fall given increased supply in the market, and we're now seeing June CPI excluding fresh food and energy as well. Core CPI rising 2.2% year on year, but really that headline number year on year growth of only 2.4% coming in below estimates, but still above the Bank of Korea's inflation target of 2%. So we'll continue to watch whether prices continue to be reined in that country as we're setting up for the Asia market opens. Of course, we saw the Korean won already pressured again overnight, one of the leading decliners in the Asian session, given the strength of the dollar. And given that strength of the dollar, we continue to have weakness in the Japanese yen. We're talking about surpassing that 161 level, despite the fact that we have seen Nikkei stocks rise for 2-3 consecutive sessions. The fact remains that confidence might get hit if we continue to see deceleration at this rate in the currencies, according to some of the analysts that we have spoken to. Right now, we're seeing some downside for Sydney futures of 0.3%. But of course, we've been following the bond space. Take a look at the U.S. future space, because it was really the Treasury market that got hit. We are talking about yields continuing to rise, and the expectations of where bonds go from here is sort of changing a little bit after the debate that we saw between President Biden and President Trump. Whether we would see more really fiscal stimulus coming in. Will that lead to more inflation is a key question. So a lot of people just positioning differently now in the bond space. We're seeing U.S. futures to the downside in the stock space of about 0.1% for NASDAQ 100 futures. But Belle, it was really that trade in the Treasury space that took our attention.
Yeah, that's right. And as you say, traders just really trying to understand and map out what a Trump victory really could mean for the bond space. And as you said, there's that focus on the fiscal side, though it does need to be said that neither party is really seems to have mapped out a strategy so far for bringing down spending. But the fiscal side, and then you can add to that these concerns around immigration reform, tariff threats as well. Certainly, as you say, really playing out in the Treasury space.
Yeah, and that's continued for a few days since the presidential debate, right? Because we continue to see this skepticism over President Biden's candidacy going into the November ballot. So we are now seeing really his allies trying to stamp out any chatter, especially within the Democratic Party, that he might get replaced. So we're now hearing that the nomination for his candidacy might come as early as mid-July. Of course, that would not only put him on the ballot for November, which needs to be the case, but also it could sort of quiet down those rumors that he might get replaced given his stumbling performance, Belle, in that debate.
Yeah, and Shery, as you say, it's really about trying to shift the attention away, make these debate pivots. And another one, of course, could be former President Trump's win of sorts in the Supreme Court, because the criminal trial over Trump's attempt to overturn the 2020 election could be delayed for a year or more. And that's after the US Supreme Court ruled that presidents have some immunity for so-called official acts. Bloomberg political news director Jody Schneider joins us now from Washington. And Jody, just lay it out for us. What are the sort of political implications of this ruling on immunity?
Well, the big implication is that Donald Trump is unlikely to face any more court cases, any actual trials in this calendar year before the election in November. So that's a really big takeaway from this, that he basically, given this immunity ruling, which was very highly anticipated, it's going to go back to the court now. It's going to go back to Judge Chutkan. And so it's almost impossible. There's virtually no chance that this will get heard and will be set for trial before the November election, which is a very big political win for the former president, who has said he wanted it tossed out entirely, and that didn't happen. But the fact that it is being sent back to lower court and that the Supreme Court waited so long to decide this at the very end of their term, it really means that he will not face any more legal action against him on the criminal front before the election, which is huge.
And Jody, we are expecting President Biden to deliver remarks on the Supreme Court's ruling. Is this sort of a win for the president himself as well, being able to turn the attention back to Trump?
Well, it's a win in terms of the news cycle, if you will. He has been criticized, and certainly since that debate last Thursday night, for not being forthcoming, only going to rallies. He had a rally the day after that disastrous debate where he looked good. He looked, that he was much more vital, say, than he did the previous evening, but he had a teleprompter and an audience. So he is going to try, certainly, to be before the press more, to be before, to be commenting a lot more on news of the day. And here's an opportunity, certainly, to come out and to criticize his opponent and to criticize the Supreme Court, on which Donald Trump had 3 justices he appointed who ruled in the majority. So that's certainly a talking point for Joe Biden. But on the other hand, it doesn't help him the fact that Donald Trump will not have to really worry post his sentencing in the New York case, which is July 11th. After that, he's probably not going to have to worry much about court cases, and he won't be spending a lot of his time this fall in the courtroom, but on the campaign trail. And that's certainly not something Joe Biden wanted to see.
Yeah, and of course, Trump, if re-elected, could order those federal trials against him closed. But let's just focus on what Shery was saying about as well, this chance that the Democrats could be weighing this vote in mid-July to formally tap Biden as the nominee. There are the advantages of that it could stamp out any sort of chatter of him being replaced. But is that going to really work? And what are the risks as well?
Yeah, and there are certainly risks to that. This is news that Bloomberg broke today, according to people familiar with the matter, that the Biden campaign is looking at having the president made officially the nominee, rather than waiting until August 19th, which is the start of the convention, the Democratic Convention in Chicago, to move it way up to July 19th or July 21st, when the convention credentials committee will meet. It's a virtual meeting, but it would be a loophole, if you will, that would allow him to be officially nominated. Obviously, putting him on ballots much sooner, and giving less opportunity and time for naysayers, people who were very disappointed in the debate the other day, to look for ways to replace him on that ballot, making it harder for any of those kind of efforts to surface, even as his close advisors and Democrats generally rally around him, saying it was one bad debate night. They have to stick with him as a nominee. And this looks very much like a move to do that. Again, they're considering it. We don't know that it will happen, but and there's risk involved. I mean, a lot of the populists may look at this and say it's kind of a dirty tricks move. Why don't you just wait till the convention, where presidents typically are nominated, in this case renominated? But it certainly has that risk, and it also has the risk of looking like he's trying to distract from some of these issues.
Jody, just quickly before we let you go, we saw the market reaction and fallout for days now when it comes to a treasury space, an expectation that there will be inflation and more fiscal stimulus after the November elections. Is that assumption correct by the markets given the campaign pledges from both sides?
Well, you could read it that way, certainly. I think a lot of the worry is tariffs, high tariffs that certainly we would see under, at least according to their plans, under another Trump administration. Former President Trump has made it very clear that he would seek very high tariffs on Chinese goods, for instance. So I think part of that is the market reacting. Whether or not he would actually go that far is an open question, and it's still an open question whether he wins or not. Though that debate performance the other night certainly seems to favor former President Trump in the polls, there's still a lot of time before the election. So I think the markets may be reacting a little too soon, but certainly that worry is there, and a lot of it is tariff-driven.
Right. Still a long time left in the political, how a political campaign can turn, right? Jody Schneider, Bloomberg Political News Director there with the latest on the presidential elections coming up in the U.S. And of course, as investors are watching that political risk, they're also getting ready for second quarter earnings. Goldman Sachs is warning that corporate America faces the highest earnings bar in almost 3 years, especially on AI-related names. Our next guest is pushing back on the AI trade. It's over sort of convulsions in the market and says such concerns are overdone. Elfreda Jonker is client portfolio manager and investment specialist at Alphinity Investment Management. Great to have you with us, despite the fact that there might be some legs left in this rally. When it comes to the earnings growth, is it going to be sort of a divergent picture, Magnificent Seven versus the rest?
Yes, good morning, Shery. I think that's 100% right. I think as we normally go into reporting season, and what we've seen over the last few is that there's a number of question marks that pop up on these companies like an Nvidia and Microsoft that's really benefited from the AI trade, and that's given us incredible earnings growth. I think the important thing to note is that, yes, the market has put a high bar on what is expected into the next quarter. So overall, consensus is currently expecting around 9% earnings growth, which is quite a lot. If you think back the last few quarters, we haven't really had a lot of growth. And that Mag 6 now, Mag 5, if you exclude Tesla, those companies are expected to give us earnings growth of around 30%, and the rest of the stocks in the S&P 500 only around sort of 3% or 3 to 5%, depending on if you include the Mag 5 or 6. But the bottom line here is that, yes, these companies have rallied a lot. We have seen some multiple expansions, so they're really not as cheap as they used to be. But if you look at that sort of differential in earnings, it is still stark. I think the big thing to bear in mind is that the market is expecting that differential to reduce. And then the question becomes, what do you pay for that differential? So yes, we are still bullish. We definitely still have our positions in those AI beneficiaries, but it's also important to just ensure you keep those positions in check. So we've consistently been taking some profits there at the top just to ensure that you have a bit more of a balanced view given this sort of differential reduction expected.
You say in your notes that you're also consistently adding more cyclical exposure. I guess, is this because you're trying to diversify away from those growth names? And how much of it is also the expectation of perhaps fiscal expansion, as we've been discussing with Jody Schneider just earlier?
Yes, it's really been over the last 12 months that it's definitely the first that you've mentioned. It is that requirement to diversify away from just having exposure to one big theme. And there's obviously risks around AI and a lot of it being front-loaded, and that the rally will be a longer and probably not as steep a rally as the market's currently expected. So we have been adding cyclical exposure over the last 12 months, and it's really on the back of really looking at what other sort of sectors are there in the market that's underpinned by structural themes and also sort of new emerging themes. So, for example, some of the cyclicals that we have added is sort of in the more on the industrial space and benefiting from decarbonisation and electrification, but also of late we've added some companies that's benefiting from capital markets opening up and for example, some of the healthcare stocks that's actually fallen behind. So on the cyclical side, I would say financials, yes, we've added a stock like Bank of America, for example, but also, again, trying to diversify and really align it with a number of those sort of themes that we're starting to see come through in the market. Particularly in the US, you have seen cyclicals already outperforming quite a bit over the last 12 months. So again, it is important to ensure that you're just balancing it and keeping those position sizes in check.
Elfreda, I'm curious because some of those themes as well, China is one of the key markets in it, for instance, the energy transition, capital market reform. Are you still staying away from that market, or are you becoming a little bit more optimistic toward it?
Yeah, so currently we don't have a lot of exposure in China. We are very, I would say, cautious still, just given the growth that's still, I think, stifling and the government commitments not necessarily coming through as fast as you would have expected. So we've not really had direct exposure in China. We've preferred to take exposure through, sort of more the US and European listed multinationals. But yes, I think as far as that transition is concerned, what is very clear for us, and a recent trip that we've done to the US again, seeing around 30 industrial companies, is that transition trade and the green trade in particular there's definitely a bit of a stalling there with companies getting a bit more muted in their outlook. I think obviously the elections, as we've just spoken about, and Trump being very open about, not necessarily being very supportive of electric vehicles and a number of these green trades that we've seen, you need to bear that in mind when you do sort of focus on these positions specifically. So, yeah, I think for us at the moment, we do try and diversify away from those markets such as China. And the support that we see in the stocks that we have is sort of limited, even though some of them are exposed. But we're looking for those that's not 100% dependent on those markets coming through in the shorter term.
And just that idea of rotation as well, what are you thinking about the health of the US consumer, and what's going to be also coming out in, for instance, luxury names in this earnings season?
Yes, if you look at the upcoming earnings season, we do think it's going to be still quite tough for that luxury space. Overall, the consumer in general, I mean, if you look at confidence, that's really low. But then again, if you look at the balance sheets, and if you hear a company like Bank of America, they're actually saying the consumer balance sheets are still relatively strong. So I think it is really an environment where you need to be pretty selective and look for those areas within consumer. For example, consumer are still spending a lot on sort of more on events and going out and travel. So that aerospace side has still been pretty strong. But on the other hand, athleisure, luxury, those have actually really come under pressure, and us at Alphinity specifically look for earnings surprises and positive earnings revisions. And sectors like the luxury names, it's across the board. It's LVMH, which we've previously held in the portfolios, but it's also Gucci, Kering. A lot of the names are currently really under a bit of pressure and seeing sort of more earnings downgrades coming through. So we expect it to be a tough reporting season for them. And we'd rather be focusing on those that's exposed to more travel, like an Airbnb, for example, that still sits in our portfolios.
All right, that was Elfreda Jonker there, Client Portfolio Manager, Investment Specialist at Alphinity Investment Management. We'll have more ahead on the Asia trade, counting down to the start of trading for Japan. Futures looking a little bit weaker at this point in time. This is Bloomberg. Well, some of China's biggest mutual funds are said to be asking brokers to lower trading fees. For more, we're joined by our China correspondent, Min Lo. And Min, this is according to our sources here, but what we're hearing is that some of the fee cuts that are being sought are really significant. So how likely is this to get over the line, and what's the rationale for it as well?
Yeah, well, some of these mutual funds used to pass on these broker fees to investors, but now a new CSRC ruling, the Chinese Securities and Regulatory Commission, has put a halt to that practice. So now these funds are asking brokers to cut down their fees because the funds are looking to cut as much as 70% of their costs to investors. So they're in talks now, and our sources are saying that these brokers are going to provide their services for free for now, starting Monday. We don't know, well, at least until an agreement is reached, and we don't know what will come out of those talks. And in the short term, this may cause liquidity to tighten in the debt market, especially for some of these more cost-sensitive funds who may decide to just bypass these brokers altogether. Of course, that's going to be more time-consuming and inefficient, but we know China has been trying to make trading less expensive. It's been trying to cut down these bond trading fees and regulate the fund's operations. And according to state media, a recent move to cut commissions that these funds have to pay for stock trading would save investors about 20 billion yuan a year. So there are now 6 major bond brokers that engage in intermediary services like helping to identify buyers and sellers. And it looks like some of these biggest brokers are looking at profits declining already in the last year by as much as 20%.
And maybe at the same time, though, authorities not necessarily liking the record-breaking bull run in the bond market that we're seeing. Are they expected to take any action soon?
Yes, the PBOC has signaled that it would be borrowing bonds from primary dealers after carefully studying and observing the market. And this really comes after several verbal intervention, if you will, that came through the PBOC-backed newspaper. The PBOC repeatedly warning against this bond rally, saying that the 10-year note yields should really stay around 2.5% to 3%. But yesterday we saw that record low yields hitting 2.18%. Before paring back some of that drop later on. And this is the clearest sign yet that the bank could be borrowing those bonds to sell even as early as this week, some analysts said. And this kind of speculation around bond trading really came about after a previously unpublished speech of Presidency began circulating in China about a couple of months ago, where Presidency talked about using bond trading as a tool for monetary policy. Now, in practice, it's hard to say how this will work out because the PBOC doesn't actually hold a huge amount of sovereign debt that allows it to sell in large enough quantities to move markets significantly. And so this move, currently it owns about 1.5 trillion yuan in bonds. A majority of those have very short maturity date. And currently the move to borrow those bonds could be interpreted as perhaps the PBOC trying to accumulate assets that it can sell later, or it could simply be trying to inject liquidity as it borrows. And analysts say it's not likely to move markets in a very big way because it also wouldn't want to lift yields that much significantly in a way that could squeeze the cost of borrowings for local governments as well.
All right, Min, well, China bonds trading in the next hour, and Bloomberg Intelligence saying 2 to 2.1% could be the next handle to watch. But that was our China correspondent there, Min Lo. We'll have more ahead on the Asia trade. This is Bloomberg.
U.S. futures muted in Asia trading after some marginal gains in the overnight session. Of course, we're watching the Treasury space very closely with investors positioning for sticky inflation. We'll have more. This is Bloomberg. This is the Asia Trade, about 30 minutes away from the major market opens. Here are the top stories that you should know. Treasuries in focus as traders weigh the possible economic implications of a second Trump presidency. The likely Republican nominee has scored a win with a Supreme Court ruling on his claim of presidential immunity, set to delay any criminal trial over the January 6 riots. Democrats, meanwhile, are set to be considering an early Biden nomination to quash talk of changing candidates after last week's poor debate performance. And the PBOC says it will borrow government bonds from primary dealers, a sign it may be contemplating selling securities to cool down the market rally. It comes after Monday's drop in China's benchmark sovereign 10-year yield to a record low. The largest union, Samsung, says it will stage a 3-day walkout beginning July 8th in its latest push for better pay. The decision was announced after the latest wage negotiations failed to yield any breakthroughs.
Well, Shery, let's stick with Korea because for the first time in about 2 decades, stocks there are getting more love than local bonds from global investors. Our Asia equities reporter Yu-Kyung Lee joins us now to explain why. Yu-Kyung, I have to say, for a journalist like yourself, based in Seoul, focusing on the stock space, I mean, this must be pretty exciting for you.
Indeed, yeah. But interestingly, even though we have seen this biggest inflow to Korean stock market from foreign investors since 2010, the market hasn't been really outperforming in the region, and that might be exactly why we're seeing strong inflows from global funds. One of the strategists I talked to said South Korea offers a cheap value trade opportunity because even though there has been a lot of opportunities such as the strong exports growth and AI trades, the market overall hasn't been really performing well compared with peers like Taiwan or Japan. But we're still seeing South Korea getting a lot of love from, especially stocks, a lot of love from foreign investors. So if you look at the foreign inflows through 2024, it's been the market that's the strongest inflows in Asia outside Japan at about 17 billion. And that compares with the South Korean bond market, which have seen only 16 billion inflows on a net basis so far this year, and that's about half of what the bond market have been seeing in the 2023 entire 2023. So if it stays this way, we might see for the first time in 20 years that South Korean stock market seeing stronger inflows than the South Korean bond markets.
But I guess, as you said, the question is whether this trend continues, right? And as we speak to analysts, for example, that have been watching both the Korean and Japanese market, it seems that there isn't that great optimism in terms of corporate governance improvements that we've seen with the Value Up program in South Korea. So what are the factors that will determine if stocks continue to gain popularity?
I guess there are 3 major factors that we could watch. The number one is, yes, of course, the corporate reform initiative that has been started earlier this year, and whether that momentum continues through the rest of the year. That will be keenly watched topic by the global investors. Another is the AI trades and the export growth momentum of the local chip companies. We've just seen that last month the South Korea posted its biggest record chip exports, and whether such strong demand from around the world for South Korean chips continue will also determine whether whether foreign investor will still stay interested in the South Korean chip makers such as Samsung, SK Hynix, and their supply chains, which have been drawing the bulk of the foreign investors' money through the year. And the third factor might be some of the geopolitical issues, such as the U.S. presidential election, which could increase volatility. And if you look at equities are very sensitive to volatility and the geopolitical event and the global bonds. So that also could determine the continued inflows of foreign investors into South Korean stock market.
That was our Asia stocks reporter, Yu-Kyung Lee there, and we'll have more ahead on the Asia trade. This is Bloomberg. Well, Australia's opposition Liberal National Coalition is promising to build the country's first nuclear reactors if it wins the next year election. They say the plan will deliver clean, cheap reliable electricity, but the Albanese government is dismissing the idea. Bloomberg's Paul Allen explains.
Of all Australia's mineral riches, perhaps the most underused is uranium. About 1/3 of the world's reserves are here. Despite the abundance, Boss Energy is one of just 3 companies producing uranium, and all of it is exported. The country's opposition Liberal Party wants to change that, with a plan to build up to 7 reactors on former coal-fired power station plants to ensure energy security.
I'm very happy for the election to be a referendum on energy, on nuclear, on power prices, on lights going out, on who has a sustainable pathway for our country going forward.
There's no shortage of barriers to nuclear energy in Australia. Forget community resistance. Nuclear power is currently illegal, banned by a 1999 Act of Parliament. Assuming the law gets changed, there's still the issue of cost effectiveness. Major generators like AGL and Origin aren't eager to spend on nuclear.
If things go wrong, they can go very wrong, which is why modern nuclear facilities are built with safety in mind. And this can make them expensive. They can also be even more expensive if they're being built in markets that don't have experience in constructing nuclear power or nuclear supply chains, where there isn't supportive regulation, policies or politics, or where there might be legal challenges. And unfortunately, Australia faces all of those hurdles.
And then there's time. Even if the other hurdles are overcome, it would be 20 years before the reactors would be supplying electricity, a much slower rollout than renewables.
We know that Mr Dutton wants to slow down the rollout of renewables, and he wants to introduce the most expensive form of energy that's slow to build. But today, we've seen no costs, we've seen no gigawatts, we've seen no detail. This is a joke.
Australia does have one operational nuclear reactor, this research facility at Lucas Heights on the outskirts of Sydney. It mainly produces cancer medication. At this stage of the nuclear debate, it seems unlikely to be joined by any more.
Paul Allen joins us now for more from Sydney, and we've got also for more insights Richie Merzian. He's acting CEO at the Smart Energy Council in Canberra. And Richie, Paul just laid out some of the hurdles that Australia needs to overcome if it even were to think about implementing nuclear power. But what's your take on the policy that's being proposed, and do you see it as something possibly that does distract from our net zero goals instead of being something that could aid them instead?
Australia's transition right now is being shaped by renewable energy. That's something that's being led by households, with 1 in 3 houses in Australia already with solar panels on their roofs. So Australians are already enjoying the benefits of residential solar, and now there's a massive scaling up of commercial large-scale solar and wind projects across the country. We're at 40% renewables. We could be hitting 80% by the end of this decade. We could be at 100% by the time we even actually consider a nuclear power station coming online in Australia. So just in terms of the timeframes and in terms of the connection, the support, the community support for renewables, we're seeing this just leagues ahead. The other thing is obviously the legal barriers, nuclear being illegal, as well as being relatively slow to bring online. And then finally, of course, it is far more expensive than renewables. So it just seems like too far off, too expensive, and a little bit too hard to actually bring online here.
Why then do you think this nuclear proposal is even being suggested in the first instance from Peter Dutton?
It's a great question. It's one that many of us have been asking. Ultimately, it does mean that we have to keep our coal-fired generators online longer. 90% of our coal-fired power will retire in the next decade. We have a little bit of gas that we use for peaking, as well as a bit for base load, but we won't really need that much more gas ultimately. What nuclear power means is that we have to find ways to sweat out these existing assets, and ultimately that means that it'll be taxpayers propping it up. We saw in the largest state in Australia, New South Wales, a deal done with Eraring, the largest coal-fired power station known, to keep that online for an additional 2 years, and that could cost upwards of about $500 million to do that. So ultimately, who benefits from investigating and trying to proceed with nuclear are the existing asset owners. And the coalition's track record in the past has been one that's tried to sweat out these assets for as long as possible And unfortunately, that seems to be the case with this current proposal now.
Richie, in some respects, you could make an argument for it, though, because the uranium is here in Australia. The country's geologically, politically stable. There's lots of suitable sites. There's even the potential to control the entire nuclear fuel cycle. But did this all kind of need to happen 20 or 30 years ago, considering the advances in renewables? Has the window for going nuclear closed in Australia?
It seems a little bit too late in the game to investigate it. Even the energy market operator can't look at what the energy mix could possibly be, simply because nuclear is illegal. So just the legal and regulatory barriers alone will take years to work through. And then from there, you have to figure out how we potentially insure it, how we can ensure that we have water supply. We're a water-stricken country, how you bring about social license. And on top of that, how you do this on time and to cost, which seems to have evaded most other Western countries that have gone down this path. We've had nuclear debates in the past in Australia. Obviously, we've had uranium as an export for a long time. But every time we've had that debate, we've landed on, let's just continue to proceed with renewables. Feels like once again, we're having that debate with an actual proposal on the table. But the debate's been done already, and most companies are backing in renewables. Most households are backing in renewables. And if we allow this to distract ourselves from the renewable rollout, we could end up with more costly energy bills, which are being inflated by propping up coal and gas. So really what we want to see is we want to see renewables continue to come online. We want to see Australians enjoy cheaper power bills. And we want to see Australia use that clean energy to power its industries for the future. Australia's a major energy exporter, the third largest exporter of fossil fuels. We want to see Australia continue to be an energy player in the region and to supply with clean energy, and that comes from renewables.
One advantage of nuclear is that it's always on. It doesn't matter if the sun isn't shining or the wind isn't blowing. But has battery storage caught up enough to nullify that advantage of nuclear energy?
Batteries we're seeing come online at quite a dramatic rate. Australia's really pushing the barrier on big batteries, on clean energy storage. The federal government has taken a major position in backing in Snowy 2.0, a huge pumped hydro project not far from where I am here in Canberra. So we're seeing clean storage come online, not fast enough. What we want to see is we want to see residential batteries supported. Right now, we could be rolling out 1 million household batteries, which would provide these virtual power plants, the storage that we need to support intermittent renewables. The government could be doing that by using its existing frameworks. We've managed to really nail rooftop solar. That was through our renewable energy target and scheme. We want to see something similar for batteries, incentivize batteries per households by putting it into the same framework and roll out household batteries at speed and scale that will directly support households, as well as providing that clean energy storage that you quite rightly point out we need to bring online.
Richie, we've got some research at Bloomberg talking about national emissions in Australia, and they've fallen roughly 20% since 2005. But a lot of that reduction has come through land use change, forestry accounting, but total emissions from other areas, according to our research, are largely flat. So are we doing enough to decarbonise at this point in time?
The short answer is no. Australia has a lot more work to do to decarbonise. The electricity sector remains the highest polluting sector, and it hasn't seen that transition happen at speed and scale. Renewables will certainly help. But the other thing is we've done very little on transport. Up until a few months ago, Australia didn't have a fuel efficiency standard. So there's a lot more work that we need to be doing in that space.
Richie? All right, Richie Merzian, we'll have to leave it there. That was our acting CEO at the Smart Energy Council, along with Paul Allen and Shery, watching some remarks here from President Biden.
For all practical purposes, today's decision almost certainly means that there are virtually no limits on what a president can do. This is a fundamentally new principle, and it's a dangerous precedent, because the power of the office will no longer be constrained by the law, even including the Supreme Court of the United States. The only limits will be self-imposed by the president alone. This decision today has continued the court's attack in recent years on a wide range of long-established legal principles in our nation, from gutting voting rights and civil rights, to taking away a woman's right to choose, to today's decision that undermines the rule of law of this nation. Nearly 4 years ago, my predecessor sent a violent mob to the U.S. Capitol to stop the peaceful transfer of power. We all saw it with our own eyes. We sat there and watched it happen that day. Attack on the police, the ransacking at the Capitol, a mob literally hunting down the House Speaker, Nancy Pelosi, gallows erected to hang the Vice President, Mike Pence. I think it's fair to say it's one of the darkest days in the history of America. Now the man who sent that mob to the U.S. Capitol is facing potential criminal conviction for what happened that day. And the American people deserve to have an answer in the courts before the upcoming election. The public has a right to know the answer about what happened on January 6th before they are asked to vote again this year. Now, because of today's decision, that is highly, highly unlikely. It's a terrible disservice to the people of this nation. So now the American people will have to do what the courts should have been willing to do, but will not. The American people have to render a judgment about Donald Trump's behavior. The American people must decide whether Donald Trump's assault on our democracy on January 6th makes him unfit for public office in the highest office in the land. The American people must decide if Trump's embrace of violence to preserve his power is acceptable. Perhaps most importantly, the American people must decide if they want to entrust the president once again, the presidency, to Donald Trump, now knowing he'll be even more emboldened to do whatever he pleases whenever he wants to do it. You know, at the outset of our nation, it was the character of George Washington, our first president, to define the presidency. He believed power was limited, not absolute, and that power always resides with the people, always. Now, over 200 years later, with today's Supreme Court decision, once again, it will depend on the character of the men and women who hold that presidency that are going to define the limits of the power of the presidency, because the law will no longer do it. I know I will respect the limits of the presidential powers I have for 3.5 years, but any president, including Donald Trump, will now be free to ignore the law. I concur with Justice Sotomayor's dissent today. Here's what she said. She said, in every use of official power, the president is now a king above the law. With fear for our democracy, I dissent. End of quote. So should the American people dissent. I dissent. May God bless you all, and may God help preserve our democracy. Thank you. And may God protect our troops.
Why are you the best Democrat to beat Trump?
What makes you so confident you should be the president? You were just listening to President Biden delivering remarks on the Supreme Court's ruling on Monday that former President Donald Trump has some immunity from criminal charges over what happened on January 6th. We'll have more ahead on the Asia trade. This is Bloomberg. Companies are really dealing with rising prices and how to send that to consumers. First, there was shrinkflation, where packages just got smaller. Well, now consumers are confronting what's called upflation. Companies seeking to claw back sales in the $100 billion personal care and beauty market. Our consumer reporter Leslie Patton joins us now with more. Leslie, so what are some of the economic issues that American consumers are facing now that's leading to what's being dubbed upflation?
So we've all seen it in the grocery stores, in the store when we're buying anything these days. Things are more expensive, and the problem is that that's been the case for 3 or 4 years now. Disposable incomes haven't kept up with inflation, and people are really struggling.
And so, Leslie, what are the changes then that companies are making? Just talk us through exactly how upflation works and also how widespread is it?
So companies, they're trying to keep sales up at these price increases. start to generally taper off. So taking everyday essential items that we know and use and love every single day, things like razors, deodorant, shampoo, finding new uses for them, in some cases innovating, finding a new need, and then charging a premium for that. And one of the best examples that we have is all over body deodorant that's really taken hold across the US just this year. So deodorant that isn't just for your armpits, but can really be for any areas of the body, things that you're worried where you have odor concerns, like your feet.
So how much are Americans really buying into upflation? Are they really falling for it? And is this only a strictly American phenomenon, or can we see it somewhere else around the world as well?
It's a great question. I think it's a little early to say if this strategy is successful or not. But in the example of the all-over body deodorant, Procter & Gamble tells me they really have come across a new need of consumers, a real concern. They did a study. It did show people had a lot of body odor concerns, not just in the armpits, but in areas like the chest and the feet, like I said, too. So they're having some initial success, they tell me, with this new body deodorant. It's selling more than forecast. And in terms of an American phenomenon, yes, I think at this point, the upflation is an American phenomenon, but we could see it start to take hold in other places, too, because I know retail sales have been pressured, have been growing slower in other places, too, like in China.
That was our Bloomberg consumer reporter Leslie Pannon there reporting on today's Big Take, and you can read more on that story on the terminal or on Bloomberg.com. Some of the other stories that we're tracking as well, Bloomberg has learned that Bridgewater Associates is launching a $2 billion fund that uses machine learning in its decision-making. Sources say the fund began trading Monday with capital for more than half a dozen clients. We're told the hedge fund giant is leaning on its own technology, but that the new fund will also broaden to include other models, including OpenAI. Northern Data is said to be considering a US IPO of its combined AI cloud computing and data center businesses. The potential listing could fetch a valuation of as much as $16 billion and is targeting a debut on the NASDAQ as early as next year. Sources say Northern Data may also sell a minority stake in the unit to investors. More ahead.
This is the Asia Trade. We're counting down to Asia's major market opens. And Belle, we're watching whether we'll see that follow through in the Asian session after Treasury yields continued to gain ground. Investors really positioning for potentially stickier inflation after the presidential elections in November.
Yes, that focus really on what President Trump back in office could mean for the bond space again. But of course, reflecting as well that US court ruling that Donald Trump does have some immunity from criminal charges for January 6th, Shery.
We've already seen here JGB yields above 1% for the benchmark 10-year for most of the week because of investors really potentially positioning for a potential rate hike from the Bank of Japan in July. Of course, we have continued to see the weakness of the Japanese yen throughout the week. Now we're past that 161 level again, the weakest levels that we have seen since the 1980s. So will the BOJ have to move in order to stem those declines has been a big issue. So you can see there the 10-year yield still above that 1%. As we're seeing the Nikkei reversing 2 sessions of gains throughout the week, we're seeing it down 0.2%. But really, inflation in focus across Asia as well. We've had already a few readings, and we just got the South Korea reading. Take a look at how the Korean markets are coming online after inflation cooled more than expected for the month of June, gaining 2.4% year on year. Still, of course, above that 2% inflation target for the Bank of Korea. We're seeing the Kospi reversing yesterday's gains to lose about 0.1%, while the Korean won, Belle, is holding steady.
Yeah, Shery, and also the starter trade here for Aussie stocks this morning. At the start of the day, what we're seeing in a staggered open, of course, is moves to reflect unchanged, actually, at this point in time. But we are, of course, continuing to track the Aussie dollar. Again, a little bit weaker against the greenback here, but that is also a reflection of that dollar move and the move in treasuries, as we said, overnight, because we saw them falling. Again, a little unchanged this morning, but still we did see that drop, particularly at the longer end of the curve, given, as we said, this rethinking around a possible Trump Presidency 2.0, and as well as I said, that digestion of the US Supreme Court ruling giving President Trump some immunity from criminal charges for trying to reverse the 2020 election results. But let's stick with what's happening in the Treasury space and bring in our next guest, because he's actually updated his rates outlook, raising his 12-month forecast for the 10-year US Treasury yield to 4.25%. With us now is Vasu Menon, Managing Director of Investment Strategy at OCBC Bank. And Vasu, really great morning to have you on with that call. But tell us what's behind it and what changed your thinking.
Well, I think election risk is behind the thinking. The risk that Trump may come into power and some of his policies, if implemented, could fuel inflation to some extent. And that may lead to some rebound in inflation, resulting in our forecast being taken up from 3.75% on the 10-year US Treasury for the next 12 months, or rather 12 months down the road, we've increased it to 4.25%. It's a 50 basis points increase, but it's to reflect the risk of the election outcome, as well as the risk of an inflation rebound in the event Trump wins elections.
And what is it exactly about it? Is it the tariff risk? Is it policy around immigration? Is it fiscal prudence? What are you most concerned about or most watchful on?
Well, all of those, actually, really. I mean, there are questions of him cutting taxes, which could fuel economic growth and lead to a rebound in inflation. Immigration curbs clearly will hurt labor supply, push up labor costs. Tariffs will clearly increase import costs in the United States. So all those factors that you mentioned could lead to slightly higher inflation in the US. But at the same time, one does not want to turn too negative because at the background, the economy is slowing down to some extent. That slowdown in economic momentum could also, pull inflation down. So it's a bit of a pull and a push. But nevertheless, to be conservative, we've taken the forecast up. But, we're not suggesting that, investors bail out of the markets simply because, Trump might win the elections.
You're turning, though, a little bit more careful when it comes to your credit positioning.
That's right. We've turned a bit more careful when it comes to credit positioning because we think that, a Trump victory may not be necessarily negative for the stock markets. The outlook for the stock markets could be relatively mixed because if you go back to history, you see that when Trump was president between 2017 and 2020, the U.S. stock market, based on the S&P 500 index, actually posted a gain of 70%. So he's not necessarily bad for the stock markets. But if some of his policies fuels inflation, then that's going to pose challenges for the Federal Reserve. It may lead to the long end of the bond yield, heading higher. And therefore, we've turned a bit more cautious on, bond markets. And also because the valuations in investment-grade developed market bonds have become tighter. Valuations have become less appealing. And so we thought, we would take it down one notch from overweight to neutral. But bear in mind, we're neutral. We're not underweight. So we're not negative.
We're also seeing yields continuing to rise here in Japan. Of course, this is a slightly different calculation with the expectations that we'll see a BOJ rate hike. And that really more compelling, given that we're seeing this continued weakness on the Japanese yen. How much trouble did that spell for other Japanese assets?
Well, we've actually turned more cautious on Japanese equities. We've taken it one notch down from overweight to neutral, partly because, Japanese equities have done very well. And what you highlighted about the yen and JGBs are something to bear in mind in the background. We've discovered that, when looking at the charts, when the yen goes past 155 against US dollar, the positive correlation between the yen and the Japanese stock market tends to weaken or rather breakdown. So a weaker yen is good for the stock market up to a certain point. But once it goes past 155, it's not exactly the best piece of news. It fuels inflation to some extent. And, therefore, I'm not surprised that, JGB yields have headed higher because the markets are imputing some degree of imported inflation and in some ways forcing the hands of the BOJ.
If you're a little bit more cautious now in Japanese equities, where are you redirecting those funds to instead then? Where are you more optimistic on in Asia?
Well, in Asia, we have turned more optimistic on India. Now that the elections are over, we think that, election risk has come off significantly. We've noticed that analysts have started upgrading their earnings forecasts for Indian equities. So that's going to be good news for Indian equities. It's a tailwind. And, we looking at the holdings of emerging market funds, global funds, Asian funds, their exposure to India is still fairly light. So there's opportunity still for global investors to, increase the exposure to India, which is good news for the Indian stock market. And finally, of course, now that Modi is in power, he's talked about, taking away some of the monopolies, reforms. That's going to be good news for the Indian stock market as well. India, after all, is the fastest growing economy in the world. And we think that, investors took their eyes off India for a while. But it's time to maybe look back at India again now that elections are over.
And Vasu, what about the exposure to China by global investors? I mean, who can blame them if they don't want to be too immersed in that market, given, of course, as we started this conversation, talking about potential trade tariffs coming up as well?
That's right. Without a doubt, the trade tariffs are a risk. But we have actually upgraded China a month ago from underweight, or rather from neutral to overweight. We think that, a lot of the bad news has been priced in. It's been a fairly long time that China has been bombarded with so much of bad news. The valuations are very low in the Chinese equity markets. The Chinese government is showing a lot more resolve in terms of trying to resolve its economic problems. They've announced stimulus. We've got a third plenum coming up in July. Investors are hopeful that the Chinese government will unleash more measures to boost the economy. So we think so much of bad news is baked into China. Sure, one can continue to beat China down, but I think if you've got the risk appetite, a long-term horizon, some exposure to China still makes sense.
So Menon, always good to have you with us. He's the managing director of the OCBC Bank with his calls on the broader markets. As we continue to watch some of the big movers early in the Asian session, we're watching Samsung, of course, because we may be headed towards that walkout by the largest union at Samsung Electronics next week. They're saying that they will stage that 3-day walkout beginning July 8th. This really adding just to the challenges of South Korea's largest company. Now, this union saying that they are staging the 3-day walkout. They have some 28,400 workers, and they've just announced the decision, although the stock continues to gain ground because we have seen those record gains in semiconductor shipments, in trade and export numbers continuing to gain ground across South Korea. So perhaps the impact a little bit muted, but of course we still have a week to go. Take a look at some of those Asian energy suppliers because oil also hit the highest level in more than 2 months. We continue to have, of course, geopolitical risks to weigh for the markets, but also a hurricane in the Caribbean. A little bit of a mixed picture right now. We have more ahead on the Asia trade. This is Bloomberg.
You're watching the Asia trade, taking a look at the last trade for China bonds across the yield curve this morning. And really, the trending or the trading activity that we're seeing has been nothing short of levels that we haven't seen going back to the early 2000s here. That 10-year yield, for instance, falling to 2.18% on Monday, but certainly just really reflecting these broader concerns around the health of China's economy, this expectation for interest rate cuts, the impact as well of when you've got ample liquidity in the financial system because loan demand, we know that has been incredibly weak inside China as well, and that increase in government borrowing to boost fiscal stimulus has basically failed to put off the bond buyers so far. And now we've got the policy response from the PBOC, because it's saying it's going to borrow government bonds from primary dealers in a sign to markets that it may sell the securities instead to cool down the market rally. For more, let's bring in our Greater China Senior Executive Editor, John Liu, in Beijing. And John, let's just start off with this program. What's the trigger point for it exactly? Have we reached it yet?
Well, I think the trigger was yesterday, the 10-year government bond hitting a record low. We've had the central bank out jawboning the market for a couple of months now. We've seen yields on the 10-year drop for a number of weeks, and the central bank trying to talk the market back up, trying to emphasize that the fundamentals of the economy do not signify or suggest that the yields should be falling this much. There's some unhappiness, of course, with the central bank wanting that money not to go into the bond market, but into the real economy, into projects, into businesses, and that not happening. And now this is the latest step. The central bank governor earlier in June talked at an event in Shanghai about making preparations for trading bonds. This is the latest sign that the PBOC is speeding that up, saying yesterday that it is starting to borrow bonds from some local institutions.
And John, we have seen authorities wanting to reduce bond trading costs, and now we're hearing from sources that some of China's biggest mutual funds are asking bond traders to lower their fees. What's the latest on this?
Well, this is just an ongoing campaign by the securities regulator to make it cheaper for investors when it comes to investing in mutual funds, be it the commissions that they pay to those funds for the management fees. And so in turn, those mutual funds are trying to find a way to make up for that cost by asking brokers to reduce the fees that they in turn charge those funds. And so we've seen that with stockbrokers, and we're seeing it now with the bond on the bond side as well.
What can we expect, John, in terms of some of the changes that have been choreographed by the PBOC governor? Of course, we heard his speech in Shanghai. We do have the third plenum coming up. Could we see a big change in terms of the liquidity regime that's being implemented right now by monetary authorities?
I think it's pretty clear. The PBOC has telegraphed that there are lots of parts of the sort of transmission system that it's not happy with. We've talked about the yields on the government bonds. There's also the LPR, the loan prime rate. The central bank and the governor himself has talked about. They do not feel like the loan prime rate, which is supposed to reflect the best borrowing cost available to the best customers for China's commercial banks. They do not feel like that is reflective of the real rates that are on offer in the marketplace. And so there has been talk about instead of having the LPR linked specifically to the MLF, which is the medium lending facility that the PBOC gives to commercial banks, having that being linked to another rate, maybe the 7-day repo. And so there is a lot of talk about the central bank rejigging the way it transmits rates and liquidity throughout the market.
That was our Greater China Senior Executive Editor, John Liu there. And let's get a preview of the market action in the mainland and also Hong Kong, of course, because we're reopening after a long weekend. Catherine Nguy joins us now. She leads the Asia Equities team. And let's just start off with Hong Kong here, because as we said, we're coming back from an extended trading break. Before we went into the break, we'd seen Hong Kong looking at a technical correction and people saying basically there just weren't any catalysts. So do you think we've found a catalyst in the 3 days, or is it just set for a little bit more weakness?
Right. Thanks for having me. It's I don't want to spell out more doom and gloom, but there is a lot more doom and gloom to happen. I mean, from now until the third plenum, I think people are just going to be taking bets on either side of the scale here. Like you mentioned, the technical correction for the MSCI China, the HSI, the Hang Seng China gauge. I mean, earlier we saw the property gauge fall into a bear market. I mean, we are talking about milestones and milestones of doom and gloom, and is there upside? There are bright spots. I mean, we saw some data, in recent days about EVs, Tesla peers, BYD, Li Auto, reporting some pretty strong second quarter and June figures, and that's really kind of boosted the market in those pockets. Chips still a bright spot here, especially with the fund, the China-backed fund. So there are some bright spots in this kind of overarching sort of pessimism, but until we see some really broad turnover, people see something substantial that they can have, sink their teeth into. It's really going to be in this kind of slow grind, unfortunately.
What about the election risk? Do you think that there's more pricing to go on that? Because I think as well over the weekend and yesterday, it was that story of traders really rethinking the odds of another Trump presidency. And the risk, of course, for this region is tariffs mostly.
Right. I think that at this moment, I think people probably are saying it's too early to tell. I mean, yes, I think the debates, as we all kind of witnessed last week, I think showed a lot of weaknesses on either sides. The tariffs that have come under the current administration have been largely impacting the sectors that we kind of all expected, in terms of big tech and AI and things like that. And so I think the analysts are saying they think that this will probably continue. There's probably not going to be big shocks. Even both sides are pretty kind of strong on the tariffs, and so that tension will likely continue for some time to go.
Catherine, what's the outlook for Chinese equities in a space where, as we discussed with John, we continue to see the bond bull rally? So with yields now falling to record lows, does the equity premium, the equity risk premium really make it more of a compelling case for a sustained rally?
I think that there are a lot of maybe not as loud bulls out there. I mean, when you look at sort of the 12-month expectation, there are a lot of people kind of talking about the upside, right? That HSI, that the CSI only has room to go up, right? But it's really about sort of what happens from now till then. That's the issue, right? That it's not going to be smooth sailing, or there's going to be a lot of gyrations. And I think there's a lot of people hoping and betting that the government will finally put in some sort of drastic measure that's enough. Whether how quickly we get there and how that movement actually goes, that is I think the question. And I think at least in the short term, where everyone's kind of just holding their breath, waiting for the plenum that's going to happen in a couple of weeks.
Yeah, just a couple of weeks from now. That was Catherine Ngai, who leads the Asia equities team, and we'll have more ahead on the Asia trade. This is Bloomberg. Segantii Capital Management founder Simon Sadler and former trader Daniel LaRocca are set to return to court in Hong Kong today on insider dealing charges. Our China correspondent Min Lo joins us with the details. And Min, we know that this case was moved to the district court from a magistrate's court a couple of weeks ago, so it affects the length of the sentencing that could be possibly handed out. But what exactly we're expecting today?
Yeah, there are several scenarios that could happen. It could simply be procedural, and if either one of the parties asks for an adjournment to have more time to gather evidence to build their case, then the case could be adjourned to a later date. And another scenario is perhaps the defendants may be scheduled to enter their pleas. They may or may not enter it today. If they enter not guilty, then we would move forward to a trial, which will be set at a later date. There is not a lot we can say about the hearing today because we don't want to prejudice the case, but all we can say is, you're right, this case being moved to the district court means that the court can hand out a longer sentences of up to 7 years compared to a maximum of 3 years that the magistrate court can hand out. And this is still below the maximum penalty that an insider trading crime carries in Hong Kong, and that's 10 years. Another important point to note is that the district court tends to have the highest conviction rate among all the levels of courts, and that's mainly, it's probably because it's decided by the judge alone as opposed to in the High Court where you have a jury as well.
And we know that this case is attracting a lot of attention here in Hong Kong, but Segantii is a name that's not just known here. I mean, it's known with offices in New York and London and Dubai as well. So How significant are the proceedings here for places outside Hong Kong as well?
Yeah, it is very significant because, as you said, this is one of the oldest and largest hedge funds in Asia, and it's quite rare that such a charge is brought against such a prominent firm. And the founder, Daniel LaRocca, he's really built a reputation for himself as the block trade king of Asia. He's had solid relations with the banks in the region, and these banks would often just call Segantii as one of the first names to pick up the phone, whenever they need to offload huge blocks of shares. And this is a firm that has really had stunning returns. You take a look at that chart. They had annualized returns of 12% every year since their inception. So this case is really bringing an end to a 16-year run, very successful run of the company, because the firm has announced that it will be closing its funds and returning capitals to investors in an orderly fashion. That's, of course, after Segantii had received frantic calls to redeem nearly $1 billion worth of funds. There will be about 140 staff who would be affected by the closure as well, spanning across all these different countries. And it's unclear as of now what would happen to that company, whether, for instance, it could convert to a family office to just manage the personal funds of Simon Sadler without any external capital.
And just walk us through the details for people that are perhaps catching up. But we know it's the hedge fund Segantii, it's the founder, Simon Sadler, long-time trader as well, former long-time trader Daniel LaRocca, but it relates to possibly dealing with insider information. Just share some more details here.
Yeah, so this case is related to a block trade that happened back in 2017 that was carried out by another firm called Lone Pine Capitals. But Segantii and those two defendants are accused of insider trading ahead of that block trade. So they are accused of selling over 1.5 million shares of this fashion retailer Esprit that they already own, and on top of that they also short sold another 130,000 shares, and this took place before that block trade. And according to our Bloomberg terminal data, we did see unusual price movements on Esprit shares. It had dropped by 3% per day in the first 2 days before the trade, and it plummeted 13% on the day of the trade. So all in all, it had lost nearly a third of its value in 6 consecutive days of trading. So the case will now really rest on whether the prosecutor has evidence about exactly what kind of information was shared to the defendants. They are accused of getting insider tips from Tony Soriano, who is a man who used to work for Bank of America's Merrill Lynch, although Merrill Lynch was not named in court documents. So, it depends on whether prosecutors have enough evidence that they have acted on market-moving information here.
All right, that was our China correspondent Min Min Lo with a case that we are tracking very closely. And we'll have more ahead on the Asia trade. This is Bloomberg. We're 30 minutes into trading in Asia, and here are the top stories that you should know. Treasuries in focus as traders weigh the possible economic implications of a second Trump presidency. The likely Republican nominee has scored a win with a Supreme Court ruling on his claim of presidential immunity set to delay any criminal trial over the January 6 riots. Democrats, meanwhile, are said to be considering an early Biden nomination to quash talk of changing candidates after last week's poor debate performance. The PBOC says it will borrow government bonds from primary dealers, a sign it may be contemplating selling securities to cool down a market rally. It comes after Monday's drop in China's benchmark sovereign 10-year yield to a record low. And the largest union at Samsung says it will stage a 3-day walkout beginning July 8 in its latest push for better pay. The decision was announced after the latest wage negotiations failed to yield any breakthroughs. And as we said, 30 minutes into the trading session so far for Asian equities, and the outlook today is a little bit under pressure so far. You're seeing most of the losses coming through for the Kospi. Actually, Samsung, we mentioned that possible union action. It is a little bit higher so far today. But the main theme that's really coursing through equities so far is this implication of a possible second Trump presidency, given that we saw, for instance, the ruling from the Supreme Court in the US saying that he's got some immunity from criminal charges for trying to reverse the 2020 election results. But then as well, you've got these concerns that are floating to the surface around immigration, tariffs, and also spending plans as well. So that really played into the Treasury space overnight. And again, it's feeding across this morning. We are seeing those moves in yields so far, Shery, today.
Yeah, and of course, we continue to watch some of those energy names with oil hitting a 2-month high. We've been watching some of those companies gaining ground. Now, another company that we're watching, a global clean energy company, EDP Renewables, expanding its presence in Japan, starting with a solar farm in Fukushima. The company says the site's 63,000 solar panels should generate enough electricity to power 12,000 Japanese households annually. Joining us now is EDP's APAC CEO, Miguel Fonseca. Miguel, great to have you here with us. So now this expansion, it actually increases your presence in Japan 5-fold. Why the timing now here in this country?
Well, good morning, and first of all, thank you for hosting us. Well, why now? I think that Japan is a very interesting market right now in APAC, actually for 3 main reasons. One, there's a clear and stable regulatory and legal framework that allows investments. Second of all, there's a robust climate targets and agenda in the government pushing for circa 40% renewables by 2030. And there's a clear route to market for us to monetize our investments. That, I think, makes Japan one of our priority markets in APAC, and that's why we are investing more.
What are the challenges of this market? We've heard from some firms that when it comes to renewable business, it becomes a little bit more difficult making inroads in this economy.
Yes, I think that as in all economies, renewables always have their challenges. I think that the main challenge in Japan have to do with the permitting and licensing that is usually long. But I think that the upside in Japan is that it's very predictable. And if we put the right effort and we go through the right process, the outcome is predictable. So we have this time to market. We also have the challenge of aligning communities, but that's also our priority. And you always need to have the support. And I think that in Japan right now, with the dialogue we can have with local communities around solar, we're seeing a way through. So I think that there's actually a supportive environment when we compare versus other countries.
When it comes to policies, you don't expect any big changes coming from the revision of the national energy strategy?
No, I don't think. I think that the biggest changes are already into it. I think that Japan has rightly put now an effort in upgrading the transmission grid and the investments there. As renewables come in due to the intermittency and the requirements on the network, that's a must. The second is there is a clear framework for us on the route to market. So those of two together, I think, put us in a good position. I think that what's required now is to continue the investments in solar mainly, to put energy storage, that will be a key component as the penetration of renewables grow into the markets. But I think that right now we have all the tools and the regulatory visibility we need to.
When you're talking about this partnership with the local communities, tell us a little bit of the challenges that you're seeing there and how you're overcoming them, because it's always the local communities that's an issue, right?
Yes. For sure. I think that in Japan, and especially as an island with limited land resources, there's always the question on how do the goals in penetration of renewables match the usability of land and the availability of land for other uses. I think that the Fukushima project is a good example. It's over an abandoned golf course, so it was unproductive land that right now it's being put into good use. So I think that the dialogue on the how is very important. A second is, as Japan is very prone to natural stresses, disasters, there's always a concern, are these investments and the way we are changing the land use compatible with security of people and resources and economic activity in the region? And so part of the dialogue is also the dialogue and the work has also to be done in ensuring communities that what's being projected is being done in a safe way that will protect in the future from natural disasters.
Especially in places like Fukushima that suffer from the nuclear disaster, right? So how does Japan, for example, compare to other regions when you're trying to really bring in these new technologies and expand your business?
Yes, for sure. So between 24 and 26, EDP as a global company is planning to invest 12 billion euros. Out of that, we expect over 1 billion to come to APAC and to have circa 5 gigawatts of capacity installed. When we look into the technologies, we work with solar, wind, storage, hydrogen. I think that looking into Japan, and due to what we were saying on the challenges from the community side, etc., I think that the big priority right now is solar. Wind does carry more headwinds in terms of community acceptance due to concerns over environment, birds, over visual impact and noise. So I think that solar is clearly a priority. And the second, as I was saying, is clearly storage. Storage needs to accelerate and advance. I think that the conditions are there in terms of markets and the ability for us to monetize. So I think those two are the biggest priorities right now.
Miguel, speaking of solar, how are you managing geopolitical tensions as well? Because we're just seeing even greater focus and scrutiny on China's major role that it plays in the industry. How are you responding to that?
Yes, sure. Thank you. For sure that as a company, so going to that, it's undisputable that China plays a major role on the manufacturing of solar equipment. We manage, and we as EDP, looking into our supply chains, and also with the experience coming from the COVID years where there was a lot of stress on value chains, we are working as a global company trying to diversify that risk. So whenever possible, we try to use a diverse set of manufacturers. Most of them do in fact come from China, but that's nowadays one part of the value chain. There's also labor, structures, and other type of work that go into renewable projects that have a very localized sourcing. And so, for example, in Japan, it's true that, for example, on the Fukushima project, we're using solar panels from China, but from a diverse set of suppliers, we have not faced any constraints in the past, and we see no big concerns into the future. But we do work with local engineering, local EPCs, and I think that those are over half of the value chain in terms of value. So looking forward, I do think it's a concern or should be a priority for governments to think about the concentration of production in China, but to dispute that, given the cost advantage that China has on this production, governments will need to check if they're willing to make the investment so that that over cost on taking out production from China can be met, right?
Yeah, can you quantify just a little bit? Because if you're saying that you're quite dominant on China, like I'm sure a lot of other energy companies or renewable-focused companies are as well, can you quantify that dominance that you have, and even de-risking away from China? How much can you really do that, given the lack, perhaps, of viable alternatives?
Yes. What I meant is most of panels production come from China, so that's the largest share of our sourcing. The way we manage this risk exposure is by having first a good knowledge of all the manufacturers in China and those that are appearing in other geographies, namely the US and even in Europe, and try to diversify to the max the sourcing and the partners we use for solar panels.
That was Miguel Fonseca there, APAC CEO at EDP Renewables. Thanks so much for your insights into another type of energy now, because Australia's opposition Liberal National Coalition is promising to build the country's first nuclear reactors if it wins next year's election. They say the plan will deliver clean, cheap and reliable electricity, but the Albanese government is dismissing the idea. Bloomberg's Paul Allen explains.
Of all Australia's mineral riches, perhaps the most underused is uranium. About 1/3 of the world's reserves are here. Despite the abundance, Boss Energy is one of just 3 companies producing uranium, and all of it is exported. The country's opposition Liberal Party wants to change that, with a plan to build up to 7 reactors on former coal-fired power station plants to ensure energy security.
I'm very happy for the election to be a referendum on energy, on nuclear, on power prices, on lights going out, on who has a sustainable pathway for our country going forward.
There's no shortage of barriers to nuclear energy in Australia. Forget community resistance. Nuclear power is currently illegal, banned by a 1999 Act of Parliament. Assuming the law gets changed, there's still the issue of cost effectiveness. Major generators like AGL and Origin aren't eager to spend on nuclear.
If things go wrong, they can go very wrong, which is why modern nuclear facilities are built with safety in mind. And this can make them expensive. They can also be even more expensive if they're being built in markets that don't have experience in constructing nuclear power or nuclear supply chains, where there isn't supportive regulation, policies or politics, or where there might be legal challenges. And unfortunately, Australia faces all of those hurdles.
And then there's time. Even if the other hurdles are overcome, it would be 20 years before the reactors would be supplying electricity, a much slower rollout than renewables.
We know that Mr Dutton wants to slow down the rollout of renewables, and he wants to introduce the most expensive form of energy that's slow to build. But today, we've seen no costs, we've seen no gigawatts, we've seen no detail. This is a joke.
Australia does have one operational nuclear reactor, this research facility at Lucas Heights on the outskirts of Sydney. It mainly produces cancer medication. At this stage of the nuclear debate, it seems unlikely to be joined by any more.
Bloomberg's Paul Allen there. We have more ahead on the Asia trade. This is Bloomberg.
Chinese EV giant BYD sold a record number of electric and hybrid cars in the second quarter, boosted by discounts and new technology. Let's bring in our Asia transport reporter, Danny Lee. And Danny, these are just, blockbuster numbers, really. But given that BYD also had to price discount to get to this point, is it really good for the company? And what does it signal as well to the rest of the industry?
Yeah, we've seen BYD and a few other EV makers post record monthly numbers, but for BYD, they've had a record quarter and they're showing signs of really good momentum, but at what cost? Clearly, the cost to earnings will show in a couple of months' time when we see their second quarter results. But, when we see this idea of potentially slowing demand in certain parts of the world, at least in China, the world's biggest auto market, the biggest EV market, clearly there is a lot of appetite. And what car makers, EV makers had to do is to stoke that demand, to find that kind of competitive edge. And they've wielded the price cuts, and BYD, with having the biggest war chest, is able to do that. So really good for BYD, good for the broader industry, because China going through this EV transition, it wants to show that it can stay ahead in this race, and particularly where it's blocked out of certain markets now, such as China and potentially out of Europe with higher tariffs.
Yeah, let's talk about that, because just looking at the electric vehicle sales alone, it was 426,000 vehicles being sold or purchased by consumers. That's not quite enough to knock Tesla off its perch as the top EV seller globally. Given the tariff risk, do we see it perhaps having to be content with that second place position for a while longer?
I think it's going to be fascinating to see just what BYD does to adapt to foreign markets. Clearly, they're selling a lot more battery electric vehicles currently, but it could change up its product mix, particularly push more hybrids onto the market, plug-in hybrids onto the market, where it doesn't face additional tariffs and it can focus more on selling pure electric vehicles at home. But ultimately, we'll see later on tonight how Tesla performs in its second quarter. But it has more downwards momentum, and we heard this from Elon Musk this morning, that there would be a lot of pressure on the annual numbers. So for potentially BYD, it could still overtake Tesla, but it's going to be very, very tight across the board. And, it's still got that momentum as it sells more vehicles.
Is most of BYD's production and sales concentrated domestically? We talked about the consumption patterns and that perhaps the domestic demand for BYD might be able to offset some of those challenges coming from tariffs. But what about the production side of things? Can they diversify, or is it enough to be within China?
Yeah, BYD's production is mostly focused in China. It's trying to change that at the moment. They've got new production facilities coming online soon this year in Thailand. They've got production coming out of even Uzbekistan, and they've obviously earmarked other levels of investment in Brazil and other parts of Europe that will come on stream in the coming years. So for now, it has to produce at home, face the potentially the higher tariffs when they do come. But when it comes to sales, sales, it is getting that momentum in terms of global sales, and its exports now in the second quarter has topped 100,000, which is a new high. But clearly with the tariffs that may come down the way in terms of additional tariffs, I think we'll have to wait and see just what kind of impact that could have and how they try to navigate that.
Our Asia transport reporter Danny Lee there with the latest on BYD. And these are some of the other corporate stories that we're following. Paramount shares jumped in extended trading after a New York Times report that billionaire Barry Diller is exploring a takeover bid. Diller's digital media conglomerate IAC has reportedly signed non-disclosure agreements with Paramount's controlling shareholder National Amusements. Diller's interest comes after Skydance's takeover bid fell through. A fraud suit against stocks influencer Keith Gill has been dropped within days of its filing. A GameStop shareholder had accused Gill, also known as Roaring Kitty, of engaging in a pump and dump scheme. It's unclear why the suit was dropped. Gill was one of the faces of the 2021 meme stock craze and re-emerged in May with new posts about holdings in GameStop. China is planning a broader push to develop technology around brain-computer interfaces, the kind of technology being developed in the West by companies including Elon Musk's Neuralink. Beijing's Industry and IT Ministry says it plans to assemble a committee of industrial and technical experts. They'll be asked to come up with standards for areas including brain information encoding and decoding and data visualization.
Well, Shery, let's take a look at what's happening in the bond space this morning. We've got Treasuries back online, fairly steady right now, but certainly the action over the past couple of days has been investors really taking a fresh look at how Trump 2.0, if he is the victor in November, how that could play out in the bond space instead. And what we're hearing from a lot of different Wall Street strategists is position for sticky inflation, positioned for higher long-term bond yields off the back of that. So that's the state of play there. As we said, we have seen yields moving higher. One of the other views we're hearing from, of course, is JPMorgan Asset Management. Its chief global strategist is saying we could see possible US stagflation if Republicans pull off an election sweep in November. David Kelly told us how Donald Trump's policies could disrupt the rhythm of the US economy.
It's kind of like this very stable machine that sort of just pumps out twos in terms of growth and inflation. Well, what could change that is, something will change it. A, a shock, or B, a big policy change. I mean, we're just talking about, I do think that what happened on Thursday meaningfully increases the likelihood of a Republican sweep in November. If Joe Biden is the candidate, it's quite possible a lot of independents will stay at home, and so Republicans will sweep. Now, if they sweep, if you take Donald Trump at his word, you've got much higher tariffs. Now, tariffs are a elixir for stagflation. Tariffs slow growth and push up inflation at the same time. If you took him at his word on immigration, the economy would come to a halt because of deportation of unregistered immigrants or illegal immigrants. So, but I'm not sure if we can take him at his word. I think history suggests that perhaps it would be optimistic, or not optimistic, but it would be foolish to take him at his word in this stuff. But still, it's something to think about. I mean, some policy shock could absolutely tip this economy into recession.
Hold on a second. John said that basically Friday was the first day of this election cycle, at least for markets. How much do you actually rearrange what you think about how to position markets as a response to this idea that you think that there is a greater likelihood of a Republican sweep?
It does make a difference. I mean, let me give you one example. The 2017 tax cuts. If Joe Biden is reelected, then some of those tax cuts will be extended beyond 25, but not all of them. If Donald Trump is elected, I expect that whole thing to go through. And if you add that to what the CBO is already looking at in terms of the growth in the debt as a share of GDP by the early 2030s is going to be about 135% as opposed to 122%. So you're going to have significantly more debt if we extend all these tax cuts, and that means a higher level of long-term interest rates.
So in other words, are you more bearish on long-term bonds right now than you were, say, Thursday morning?
Yes, I think it would be a rational thing to be that way, yes.
JPMorgan Asset Management Chief Global Strategist David Kelly speaking with Bloomberg's Lisa Abramowitz. And if you missed any part of that conversation, TV Go is your function. You can also watch us live. And you can also dive into any of the securities or Bloomberg functions that we talk about. Become part of the conversation. Do send us instant messages during our shows. This is for Bloomberg subscribers only. Check it out at TV Go. This is Bloomberg.
You're watching the Asia trade, and some of the stories we're tracking along the AI theme this morning. And Bloomberg has learned that Bridgewater Associates is launching a $2 billion fund that uses machine learning in its decision-making. Sources say the fund began trading Monday with capital from more than half a dozen clients. We're told the hedge fund giant is leaning on its own technology, but the new fund will also broaden to include other models from OpenAI, Anthropic and Perplexity. Northern Data is said to be considering a US IPO of its combined AI cloud computing and data center businesses. The potential listing could fetch a valuation of as much as $16 billion and is targeting a debut on the NASDAQ as early as next year. Sources say Northern Data may also sell a minority stake in the unit to investors ahead of the listing, Shery.
Yeah, take a look at how U.S. futures are setting up for the start of trading across China. This is the picture right now. Not a lot of movement, but do keep an eye on the bond space. Of course, we have seen Chinese bond yields fall to fresh record lows, and we have seen treasuries also take a hit over concerns about stickier inflation. So really a lot of moves in the bond space globally right now. That's it from the Asia trade. Our markets coverage continues as Hong Kong is also set to reopen after a break. This is Bloomberg.